Hi, welcome to this video update, which is all about Forex fundamental and sentiment analysis, how to do it correctly. Now, in terms of most traders, when they do fundamental or sentiment analysis, they make fatal errors. Just want to go through how to do it correctly with some tips from one of the greatest forecasters around today, a guy called Nate Silver, who wrote the book The Signal and the Noise. Should be required reading for any trader because it gives you a kind of mental framework to analyze the fundamentals and sentiment correctly and make confident forecasts with good risk to reward. So I'm going to discuss some key tips from Nate Silver and also just go through how we do our fundamental sentiment analysis. And we just basically keep it very simple. It doesn't take us much time to do either. Now, I've written up some points on a storyboard, so let's go and look at how to do fundamental sentiment analysis correctly in more detail. All right, let's have a look at first 4 quotes from Nate Silver, then we'll move on to another couple. Some of our philosophy of doing forecasting and analysis, and we're just going to go through how we do it on a daily basis. Now, in terms of number 1, the signal is the truth, the noise is what distracts us from the truth. As traders, we want to trade the truth. We don't want to be distracted by the noise. Most traders are, and this is due to the emergence of big data. Big data is causing noise distraction. What is big data? Big data just refers to how much analysis and forecasting we're doing in the world today, not just in financial markets, but it could be anywhere like weather, whatever it might be. And to give you an idea of the size of big data, in the last 30 years, we've created more bytes of data in the world in terms of analysis, forecasting and statistics than we've done since man came on the earth. So thousands and thousands of years. And in the last 30, we've done more data than in the entire history of mankind. That's how much data there is around today. And the idea is that big data can help us make sense of the world. The more data we've got, the better. The more analysis we do, the better. It applies, well, it can work in certain areas of the world, but not in financial markets, because just too much data and we're distracted by noise, okay? Not seeing the truth. And in relation to this, actually, I did read a book many years ago. It was in the late 70s, called Future Shock by a guy called Alvin Toffler, and he postulated that we will soon reach a stage, just back in the late 70s, that we'll have so much data and so forth, and so much information that it will not be helpful for prediction and so forth. It'll actually make us worse forecasters. So he was really referring to kind of information overload. And when I read the book, I actually thought, I don't believe that at all. It's actually come true in financial markets, and Nate Silver is making a big reference to it. We, as traders, or the majority of traders, they don't understand how big the noise levels are in the markets in terms of price movement. They're huge, okay? But what we want to do is make sense of every twist and turn of the markets and fit a reason. We've got so much data, we can fit a reason. And with computers as well, we want to make sense of everything. Your day trader on a 5-minute chart, trying to make sense of price action, which is just noise. But it's not just, let's say, traders looking to short time frames. It's basically, and this is a real problem for a lot of traders, why they think trading is so easy in inverted commas. They look at the financial media. The financial media makes sense of every twist and turn of the market. I saw the other day, I think the dollar moved up about 30 pips or so. It wasn't very much. And I saw on a news channel that was due to housing starts being slightly better than expected. That reason has just been fitted after the event. It was probably just noise, normal ebb and flow of the markets. But there's so much economic data that you can fit it to the price section and make it sound like that's the reason why the move occurred. You got 10,000 economic reports a month from the US government alone. How much of that data is actually useful to us as traders? Hardly any of it. Maybe a handful of information. I'll come back, sorry, to the information that I find useful in a moment. But we mustn't be distracted by the noise, and it's not more is better. Okay, big data is a major problem for retail traders, and actually even, experts, so to speak, which I'll return to in a moment. Now, point number 2, distinguishing the signal from the noise requires both scientific knowledge and self-knowledge, the serenity to accept the things we cannot predict, the courage to predict the things we can, and the wisdom to know the difference. Brilliant quote. In terms of, I've already said, traders try and predict too much and just caught up in the noise. A lot of traders will actually make a fatal error of being in trades, and this is very frequent, and they don't understand what's going on. They're still in the trade. Well, if you don't understand it, why are you trading it? You shouldn't be doing it. You should only make assumptions, predictions, and trades when you're totally confident that your analysis is giving you or putting the odds in your favor. So it's less impatience, really, as well. Traders want to trade, and they'll very often trade where they're not totally confident, they don't really understand what they're doing. It should sound obvious to avoid doing it, but a lot of traders do get in trades they don't understand. Right. We've all got the same data to look at. The key is to draw different conclusions, isn't it, from the majority. Point number 3, the more interviews an expert had done with the press, Tetlock found, the worse his predictions tended to be. I love Nate Silver's Signal the Noise, obviously, but another fantastic book is Tetlock and Gardner's Super Forecasting, which really goes in depth into the type of mindset you need to make forecasts or predictions or be as accurate as you can be. You can't obviously be perfect. A lot of people look up to experts, okay, and think that their view is better. Tetlock proved that it wasn't, okay? And he did a massive study on it, that experts were frighteningly wrong. So you never want to be intimidated by the so-called experts. And a lot of traders, they see a guy from Goldman Sachs say something like gold is going up, and they wanted to be short. And they think, if Goldman Sachs say it must be true. Don't believe it at all. Okay, it's not substantiated by fact. In terms of most so-called experts, and this goes for most losing traders as well, they've got too much ego. Okay, they want to be too logical. Okay, about what might happen. They accept the obvious. The obvious is more often than not wrong, and they're too biased. Their psychological biases are really hurting their analysis, which I'll come back to in a moment. But to never be intimidated, and I think it's one of those things a lot of traders are, or they think the experts know more than them. Nothing could be further from the truth. Economy is not baseball where the game is played by the same rules. Well, that would apply to Forex trading. You can't be too logical, okay? You've got fundamental data, the facts, okay, which everyone can see, and then you've got the sentiment of traders towards those facts. And, over time, it never changes. Traders will respond to their emotions, okay? And traders can very often do what I would consider crazy things, but that's the market. So what you've got to do is analyze the sentiment towards the fundamentals, stay away from the noise, and then come in with trades that are going to get the odds on your side, which I'll go into this in a bit more in a moment. But I just want to go through one of my favorite ways of trading, which is the error of emotional prediction and anticipation. In terms of what I mean by this, and it's a great way to trade, go through some other ways of forecasting or doing trades in a moment, but what you tend to get is a market, let's say it's very bullish or very bearish. The market then kind of herds and looks for the move to continue and continue and continue, okay? And then what you get is emotions come into it, I'm sure, in terms of experts and so forth and traders make predictions and anticipate things that basically have got no substantiation in fact. Now, anticipation is from George Soros, really. He kind of popularized it, where he said, when the market gets really emotional, big move is in motion, tends to anticipate things that it thinks should happen, but probably are not going to happen. I'll give you an example, actually, just to make it a bit clearer. Just a few days ago, we had the Fed, and the Fed kind of indicated they were going to cut rates by 0.25%. So they've telegraphed that, they've told it to the market. They've also said it's an insurance cut, and we're going to be cautious going forward. It's probably going to be the only rate cut for now. But the market got into a frenzy about, well, if they're going to cut rates once, there's reasons for them to cut more. And they make up reasons, believe the Fed are going to cut more than 0.25%. Then the Fed did as expected, which they telegraphed to the market. And then the market is wrong. Okay, a lot of people sold the dollar, selling the dollar on the basis of more rate cuts to come. The Fed hadn't even indicated it. The actual view we took was, be 0.25%. They telegraphed that. Why not buy the dollar? All these traders are going to be disappointed. The Fed didn't indicate more rate cuts, and we got a massive move in our favour. Now, anticipation. You will see it all the time. If you ever see a setup where the market anticipates too much, go against the market. Okay. So the terms of the first 4 quotes. Now we need to move on to the final 2, and I'm just going to go through our sort of daily routine. Right, a couple more quotes from Nate Silver, and then we'll just look at how we do our analysis on a daily basis. Now, whenever there is human judgment, there is the potential for bias. The story of the data tells us often the one we'd like to hear, and we usually make sure it has a happy ending. Well, if you let your biases come into play in trading, you want a happy ending, but you're unlikely to get one. And it's easy to say, keep your biases out of trading. Easy to say, it's harder to do though, because you're fighting your genetic makeup. Now, in terms of if you're trading, you want to be contrary, okay? Your opinion is as good as anyone else's, and you do not want to be with the majority, okay? You want to go against the majority at the right time, okay? Whatever style of trading you've got to avoid confirmation bias. Confirmation bias is a huge problem for traders. It's one of the worst biases of all. And basically, we know that opinions once set are harder to change than to keep. That's psychologically proven. And we know that in trading, because traders don't like being wrong as a general rule, and they don't like taking losses. But you've got to avoid confirmation bias. Basically, confirming why your view is correct if you're coming into a trade or you're in a trade already, and not looking at the contrary or the opposing argument. You must run the opposing argument of why you're wrong. Why you could be wrong is just so important, isn't it? How many traders actually do it? Hardly any. Most traders want to confirm their view. They don't want to be honest with themselves and basically run the counter argument. Now, it's not easy to do. It requires practice, but you must have checklists of why you're right, or why you could be right, and why you could be wrong, and then make the right decision, not just confirm your view. Great way to help you do this is Bayes' theory. It's a probability-based theory. I haven't got time to go through it in this video, but it's just a great way of seeing the other side of the argument. Learning a Bayes net is just a fantastic way of avoiding confirmation bias. I'll let you go and read more about that online. Now, Finding patterns is easy in any kind of data-rich environment. That's what medical gamblers do. The key is determining whether the patterns represent noise or signal. Basically what we've been talking about, isn't it? Interesting point. Why have most professional funds seen a performance decline in the last 20 to 30 years? It's a massive one. If you look back to the heyday of really famous funds, 70s, 80s, when you had the turtle traders around, the Mint Fund, the Quantum Fund with Soros, all those big famous funds, they were doing fantastic performance. 30% compounded per annum, 50%, some funds doing 100% or more. Where are those funds today? They're not around. There's no fund doing 100% per annum today. Why? Well, I'm going to blame, or a big portion of the blame should go on big data. Professional fund managers are being fooled by big data. And you can see it in the performance of hedge funds. Okay, everyone thinks hedge funds, they've got all this data, computers, technology, everything at their disposal. Where's the performance today? Performances in hedge funds is dire. Simon Acker, the hedge fund Mirage, worked out if you'd invested in the average hedge fund over the last 15 years, you've actually been better off by double to go and invest in T-bill interest. They're not even doing high single-digit gains. Big data, I think, is the problem. There's other factors that will come into play, but it's well, I've said it throughout this video. It's a major problem. Markets are just so noisy. So how do we do our analysis in relation to getting the signal from the noise? Well, we'll do top-down analysis. What I mean by that is we'll take a big overall view of financial markets generally and fit the currency pairs into that view. They don't move in isolation. You need to look at how stock markets are moving, bond markets are moving, commodity prices are important for many currencies. Then you've got geopolitical concerns that come into play. You've got the personality of the currency. Once we've got the top-down analysis, that will dictate how we trade the individual pairs. Now, in relation to data, we will only look at red data, the really important data, and there isn't that much of it to look at. So when I say really important data, central bank reports, inflation, manufacturing services, PMIs, industrial production, consumer confidence, red data that you see on your Forex calendar. I use FX Street, which I think is a really good one. And very often those data releases on their own aren't going to change the big picture. We'll come back to that in a moment. Looking really to establish 3 time frames in terms of our trading. We want the big fundamentals that are going to drive big trends longer term. Okay, so there's the big fundamentals. They are not going to change around in months, many months, or even years. That will help us establish the big trend. We'll want to trade with the big trends as often as we can. Then we want the intermediate trend. We'll keep that in mind. Big trends obviously retrace. So sometimes, even though we're really, let's say, bullish for currency longer term, we might come out and decide to trade the other way. Okay, catch the intermediate move, or we might just decide to move on to another pair. Intermediate moves, they basically are how long in duration? I would say about a week to 3 weeks. As a general rule. Also in the intermediate kind of time frame are swing trades where we'll just go against bullish or bearish extremes. In terms of trades that we hold, most of them are going to be for a week or more. Occasionally you might get a trade that comes to fruition in a day or two, but it's not very often. Focused on the longer term or the intermediate term. That is where the noise levels are not going to basically hurt us. Okay, because we're going to take them into account. We won't trade really short term. Day trading, scalping, it's really hard because the noise levels are so high, and we will not basically trade pairs where the fundamentals are in balance. And that means you haven't got a clear-cut argument in favour of one currency over another. Well, if there's no clear-cut argument, most of it's going to be noise probably, so just avoid, okay? In terms of the news, what do we look at? We don't look at any unusual sources, really. We just look at the normal big financial sites, your Reuters, your Bloombergs, your CNBCs, MarketWatch, etc. In terms of that's going to give us all the facts that we need. Also give us, what the market is forecasting in terms of data or thinks it's going to be. Also give you an idea of sentiment as well. And we're always looking for anticipation. It's one of our major ways of trading. As soon as the market is anticipating something where we can see no supporting facts, we're going to want to go against the majority. In terms of sentiment, obviously, you can get an idea from reading the financial news, but we do use the COT, okay, which is our favourite sentiment tool, which tells you the big money is sitting for two key groups, which I mention frequently, the speculators and the smart money commercial hedgers. We'll also look at bank brokerage data. So what do banks and brokers think about a currency pair? If we see they're all wanting to go one way, we'll possibly be looking to go the other. And we have a few traders that we always look at because we want to fade them. Now, three traders in particular, or experts in the media, as soon as they say something is going to happen in a Forex pair, they all agree we want to go the other way. I found it quite effective, actually. But you'll find people you can fade as well. How long does this take us on a daily basis? To do the fundamentals, read up on what's important, probably about 30 minutes maybe, that's it. It'll take a little while longer when you start because you've got to build your big picture, so to speak, but 30 minutes is enough. You're looking at the sentiment towards the fundamentals all the time, okay? It can be extremely simple. In terms of, I'm just going to give you an example of our big picture. Our big picture at the moment is to buy safe currencies over risk currencies. Why? Because the big picture in the global economy is it's slowing up and it isn't going to change anytime soon. So safe currencies should do well over risk currencies. It is simple. We've done it frequently. Fantastic profits out of the Japanese yen going long of that, and also the US dollar. That big theme is probably going to continue. Obviously, we're looking at the intermediate moves as well, but big trends. It's always worth looking out for them. And I think in terms of our time frames for holding trades, we can stay away from the noise. I think you've got to focus longer term in markets. A lot of traders say to me, well, you take the risk of 100 to 200 pips per trade. That's too much risk. No, it's not, because I'm using small position size. Okay, I think if you use small position size and use a realistic stop, you'll stay away from the noise and focus on percentages that you can make. It's not about pips, it's about percentages, which I've spoken about frequently in our videos. In terms of fundamental sentiment analysis, anyone can do it, and I think you get a lot of great advice from Nate Silver's Signal and the Noise, which you should go and read. Also mentioned it earlier as well, the book Super Forecasting. Really help you get an edge and never be intimidated by the experts or other people's opinions, because your opinion can be as good, if not better, than theirs if you form it in the right way, keep it at the right time, and also ditch it at the wrong time. I think in terms of fundamental sentiment analysis, it's just basically not falling for the traps that most traders fall for. They don't even think about the traps that they're falling into. You can see from this summary that that difficult to avoid. Okay, you need to do a little bit of practice and take a little bit of a different view in terms of your mindset, but anyone can do what I'm outlining in this video and become a confident and profitable forecaster. Of course, you're not going to win all your trades, but if you get the risk to reward in your favor, only trade high expected payouts, that means we've got low risk and high reward, you can do very well. Okay, so always aim for 3 to 1 in terms of risk reward, or even better, 5 to 1. Get a lot of trades wrong and still make a lot of money. I think I've covered everything that I need to, so that is the video for today. Thank you very much for watching me as usual. Take care and have a good day.